Welcome to Upticks. I'm Jake Falcon, the founder of Falcon Wealth Advisors and your host of Upticks. Today is episode 160, Net Unrealized Appreciation. Thank you for joining me back on the show. Hope all of you out there are staying safe and healthy during this horrible pandemic. For today's topic, I wanted to discuss something called Net Unrealized Appreciation, which if you're not in financial services, probably sounds like I'm speaking in some foreign language. But it's actually a pretty neat strategy, particularly for people who have publicly traded stock in their 401k. Okay, so that's who this applies to. So if you work at a company and it's publicly traded on the New York Stock Exchange and they have an option to buy that company stock in the 401k plan, this episode of Upticks is for you. Before I dive into it, I'm so humbled. Our subscriber count continues to grow. So please hit that subscribe button, wherever side of the screen we put it on. And that's the best way to make sure that you don't miss another episode of Upticks. Also, if you think our content is worthy of a thumbs up, we'd love to see a thumbs up. That's, again, I think how some algorithm works. More people get to see our stuff if you like and share it. And of course, subscribe. If you're listening to this on your favorite podcast platform, thank you again for listening in. Same applies. Subscribe. Feel free to subscribe and hit that thumbs up button, like and share our content. Again, that's just the way that our strategy of enhancing financial literacy gets out to more and more people. Okay, so for today's topic, all right, so let me discuss what this is. So again, net unrealized appreciation, it's commonly referred to NUA, right? That's just the acronym, NUA. And the way it works is while you're working at your company, whether your employer match or maybe you just buy company stock as one of the options, one of the investment options within your 401k. The idea is hopefully, as years go on and you work at your company, maybe many decades, 2-3 decades, you start to accumulate a lot of those shares, and hopefully your stock has also appreciated in price, okay? And so that's who this is for. So somebody says, okay, Jake, over the years, I've purchased $50,000 worth of my company stock, and today it's worth $500,000. Awesome, right? We love to see that. We love to hear about that, and it certainly probably helps your financial plan. Well, what this strategy involves is something called separating service, right? So basically, if you retire or leave your company, there are also some other triggers. Typically, I believe if you're 59 and a half, you may be able to do it. But the best way, in my opinion, that I've seen it work is that when you leave, either to move on to another career or another corporation, or you flat out retire, that's what will trigger this type of event to take advantage of the NUA, or net unrealized appreciation. And so in my simple example here, let's say that again, and you paid $50,000, or that would be your average cost basis as a technical term. So if you've paid or bought in for $50,000 and today your stock is worth $500,000, well, you basically have several options, but two options that I want to talk about today is one, you could do a traditional rollover, right? And roll all of that money into an IRA. And then when you pull from that new IRA, you can, you'll pay ordinary income taxes. So for today's conversation, let's say that you're, I don't know, in the 22% bracket, okay? So the idea is you roll over, you can either roll over that stock as is or sell it and roll over the cash. You retire, you hire a financial advisor. We're gonna move everything from your 401k to your IRA. And then when you pull from that new IRA, you're gonna pay taxes at the 22% rate because that's your federal tax bracket, okay? For simplistic circumstances. And a quick disclosure, my compliance likes me to do this. Again, I'm not a tax advisor, so this is not tax advice. I'm just using this as a hypothetical, okay? So what NUA says though, is you don't roll over that company stock, and instead you transfer that company stock to a brokerage account or a taxable account. And what this allows for is, in this example, again, the $50,000 would be taxed, and again, in this example, and the 22% tax bracket. However, the good news is when you go to sell the stock, and you don't have to sell the stock upon doing the NUA. But when and if you decide to sell the stock, it's treated as a long-term capital gain. And long-term capital gain rates are generally quite favorable. And a typical rate, it could be a little higher, it could be a little lower, but a typical rate is around 15%. So again, for this hypothetical, let's say that your long-term capital gain rate is 15%. Well, in essence, so the 500,000, right? Only 50,000 of it is taxed at 22%, but that $450,000 gain is only going to be taxed at 15. So in essence, you're saving 7% of taxes on that delta, on that $450,000, just by utilizing this NUA strategy, right? So we've seen this literally save clients thousands and thousands and thousands of dollars in taxes by just executing a different type of transfer, right? So rather than rolling it over to their IRA, we've done the NUA, put it in a brokerage account. When we sell the stock, they pay long-term capital gains, and they're not paying ordinary income taxes. And it's even more advantageous the higher bracket you're in, right? So some of our clients are in the top bracket, so they're paying 39%, right? Or whatever it is, right, in taxes. So think about that delta. So even if their long-term capital gains rate is 20%, and they're in 39 or 40%, whatever, the top bracket. So for them, they may be saving 20%, right? Let alone just a 7 in my example. Now, there was a third option that I mentioned that I didn't mention actually, so that you actually can just leave the money in the 401k as well, right? So that's always an option typically with former employers. But again, even when you would execute on the NUA, or excuse me, pull money out of the account, it would still be treated as income if you left the money in the 401k, right? So the only way to really qualify for this NUA is to get the stock out of there, move it into a brokerage account, and then you get the favorable tax treatment. Now, there's some important things though. You don't want to try to do this alone because there's some very important rules that you follow. And if you don't follow them, you could get into trouble and end up paying tax penalties or taxes on the whole thing, or I don't know how bad it could be, but it could be bad. Before I go over some of those things to avoid, I want to give a quick plug to my business partners, Corey Bittner. He's got a show out there called In the Money Insight. It's right here on the same YouTube channel, Falcon Wealth Advisors Collective. And he's also got his own podcast. And then Scott Sturgeon, another advisor on our team, has 2 shows. One of his is called Mental Dividends. Again, sits right here on the Falcon Wealth Advisors Collective, and he's got his own podcast. And then he's got a second show with Joshua Briscoe from 810 AM Radio. He's a sports radio host. They do a show every week called Sports and Money. So be sure to check those out if you want more great organic content from your friends at Falcon Wealth Advisors. Okay, so what are some of the things that you want to avoid? Well, a big one is, and a lot of people don't know this, is that you have to empty the whole account. So let's say that, and again, my example, you have 500,000 in company stock, and then you have 500,000 in mutual funds or regular investments in the 401k. You can't pick and choose. You've got to empty out that entire account when you exercise this NUA in that given tax year, right? So it's very important that you want to do that. And also, if you're under the age of 59 and a half, you may be penalized on that $50,000 cost basis, but the capital gain still would be treated as such. So again, even if you're below 59 and a half, it may be suitable to you, but the key is you have to do it when you leave your employer, right? So there's all these nuances and rules that you want to be cognizant of, and you want to work with a chartered retirement planning counselor when you're exercising this. Corey and I, again, are both chartered retirement planning counselors. Scott is a certified financial planner. He is certainly capable of discussing this as well. But you want to work with somebody that's done it before, because again, if you get it wrong, you could end up having to pay more taxes than you thought you were saving. And it's not a no-brainer. If you don't have a big enough gain in that said stock, it might not make sense to do it. It actually might make sense to go ahead and roll it over to your IRA. So again, there's all these calculations that are involved. It's a pretty advanced strategy. It's something that we do a lot of at Falcon Wealth Advisors, and again, I've seen it work where it's saved our clients literally thousands and thousands and thousands of dollars in taxes. So it's pretty neat. You want to make sure you get it right. You want to make sure you work with a qualified professional that knows what they're doing. And you also want to double check with your CPA that they are familiar with reporting all this. That's a big one there, because a lot of CPAs, believe it or not, aren't too familiar with this strategy. So if your accountant's not familiar with it, you want to find an accountant that is, because if they get it reported wrong, well, then it'll just completely negate everything that we try to do as far as tax planning, right? So work with a CPA that understands this. If If you don't have one, certainly Falcon Wealth Advisors, we're happy to help you find one. But again, this is a great strategy that if you work at a publicly traded company and you have company stock in your 401k and it has appreciated significantly, you may be eligible to do net unrealized appreciation or NUA when you go to retire. I'm going to put my email here at the bottom. It's simply jake@falconwealthadvisors.com. Certainly, if you have any questions, please feel free to send me an email. I'm also out there on the various social media platforms. So I'm on Twitter, Instagram, Facebook, and LinkedIn. Also, my practice, Falcon Wealth Advisors, is on the same 4 platforms. Okay, that's all the time that I do have for you today. As far as fun things, just been hanging out with my puppy Einstein. It's been a lot of fun. I did just buy a Peloton bike, so I'm real excited about that. I really got it for Rachel, but I'm certainly going to hop on that thing, hopefully at least once or twice a week. So hopefully I'll send you some pictures of that. Did make a trip down to Southern Hills in Tulsa. Had a great time playing golf with some clients and friends. This morning, it's raining pretty heavily in Kansas City, so I guess fall is starting to swing its way in. But like I mentioned in the beginning of the show, I hope all of you out there are staying safe and healthy, and I hope you have a great day.